How multifamily real estate will be affected by the latest Fed fund interest rate cuts. So it's been the talk of mainstream media for the past week. You can see a headline here on CNBC: Fed slashes interest rates by a half point, an aggressive start to its first easing campaign in 4 years. So, what does this mean for multifamily real estate? A lot of the information out there is directed towards housing and single family houses. I will say that multifamily does have an intrinsic connection to housing. So, when housing inventories are low, typically multifamily housing inventories are low, um, and vice versa. It's rare that they diverge too much. So, a lot of the information we're talking about in residential housing also applies to multifamily housing. So, let's break it down a little bit. In the past, definitely the past 6-12 months, we've seen record low inventory of housing and multifamily houses, um, but also low buyer demand. So prices have been high. Sellers have thought, hey, because interest rates are high, there aren't enough buyers out there to actually purchase and afford these properties. So, what would happen when interest rates come down? That will answer the ultimate question: was interest rates the real reason why transactions weren't happening, or was it something else? And now we're actually at the point where interest rates have come down. We can see if it was something else or whether it was interest rates. So, very interesting time for our industry at the moment. Now, a lot of sellers have been waiting on the sidelines. Maybe they wanted to sell 3 or 6 months ago, but they said, hey, let's wait until interest rates come down and then we can put our property on the market. And that's a pretty widespread mindset. So while we have had low inventory and high prices, the expectation is that inventory will go up with a lot of sellers looking to offload their properties. The big question is what will happen on the buyer's side? Will buyer demand go up to match it because interest rates are now lower? Or will buyers still remain on the sidelines? And that's what we're going to dive into a little bit today. So, first thing I want to point out, which is very interesting, a lot of people look at the Fed fund interest rates and think that just because they were slashed last week, interest rates are instantly coming down. But that's not always the case. And in fact, that's not the case right now. So I'm going to open up here a much better indicator of the interest rates and where they're at. And that is the 10-year Treasury. So you can Google it yourself. We have the 10-year Treasury here. We can use CNBC again. And this rate here, 3.736%, is the rate, the return rate for the 10-year Treasury yield. So what I like to say, you can always add about 2.5% to this, and that's approximately where interest rates could be for someone. So that could be just above 6.2%, give or take. And I like to call that spread. That's the lender's spread. So they have to make money on lending money as well. But the interesting part is this graph here, looking at where the, call it, interest rates have been, where they've peaked. And my face here is covering it a little bit, but you can see the peak really was here at about nearly 4.9. So if we added 2.5 to that, that would be about 7.4% in October of 2023. So that's really when rates peaked. If you went to a lender and said, hey, I want a loan for a multifamily property, you'd get the height of it around October of last year. And you can see it came down actually a lot, even though the Fed fund rates were still at the same level. That they haven't changed really in the past year. you can see the rate actually dropped over a percentage point, even 1.25. At here was what are we looking? Yeah, the end of last year. So then they went up another hike up here. So this is all happening while the Fed fund rates have been the same. Very interesting. Now let's jump towards the more recent times here. So you can see rates have been coming down really since about April, May of this year. And we actually bottomed out earlier this month, which is about 3.65. So again, use the rule, add 2.5. We're looking at about just over 6% interest rate, which if you go to your lender now, you may see it around that rate. What's interesting is that since the Fed funds announcement, you can see a little bit here, I'll zoom in. The rates have actually gone up a little bit. They were at 3.6. Now they're going up to 3.7. So it's marginal. But what's interesting is that the common narrative out there is that, rates should drop 0.5% from what they're at, they're at currently. Not true. Rates have actually been coming down over the past few months. And this is the market pricing in expectations of what the Fed would do. So the Fed doing a 0.5 point reduction actually didn't do anything to the actual interest rates, which is very interesting. So all of those sellers waiting on the sidelines, thinking that rates would drop, the second that Jerome Powell announced the rates would go down 0.5 point, are actually incorrect. The rates have been coming down. Have we seen a increase in buyer demand? And the answer is no, we haven't. I wish I had a chart here to pull up to show you, but the early returns are that buyer demand has remained steady. So even though rates have come down a good percentage point since its peak, we haven't seen an increase in buyer demand. So what does that tell you? It tells you that buyers think that prices, home prices and multifamily prices are simply too high at the moment. They need to come down. The actual prices need to come down. It's not necessarily a question of being able to afford the monthly payment, but it's thinking that prices need to come down. So what could happen? Again, this is just one possibility that could happen, is that a flood of sellers come to the market, inventory goes up. If buyers choose to remain on the sidelines, we will start to see decreasing prices. Right now, everything is kind of holding steady. Depends which market you're in. You may see some decreasing in particular local markets, but overall, markets are tending to hold steady. But with an influx of inventory, could we see prices start to actually come down? And that remains to be seen, especially as we have more interest rate. So I want to turn my attention now to this chart, and you can get it by Googling mortgage applications. And this is actually a pretty telling chart. This shows the amount of new mortgages, 30-year fixed mortgages applied for, and I think it uses a trailing 30 days or 7 days or something like that. But really, I'm not too worried about the specifics. I'm just looking for trend lines, and this can be pretty telling. So the orange line here, you can actually see the average rate of 30-year fixed mortgages and how around, let's even go back further. Let's see, this is around October 23. So about 11 months ago, interest rates were around 7.79, and they have decreased and then gone up a little bit to 7.22, and then now are coming down drastically. But you can see this point where it started coming down was April 29. So interest rates, as I showed in the 10-year Treasury chart, have actually been coming down the past few months. So it's not like last week was some huge event where interest rates suddenly crashed, it's been slowly building in to the pricing, to the lending model. So again, this goes against the argument that interest rates were keeping buyers from buying properties. A lot of it was to do with prices being too high. Now, what we want to look at on this chart specifically is the amount of mortgage applications. So I want to zoom out a little bit. So I'm going to go to 5-year, just so you can see the difference. This was during the pandemic years. Mortgage applications were very high. Interest rates were very low at that time. And then they kind of fell off a cliff, over 2022 as interest rates started to rise. And you can see it overlaid on this orange line here, which is actually interest rates. So going along this line, looking at this composite index number, you can see that applications for new mortgages, meaning people looking to actually buy, have remained pretty flatline. Even as we go into, again, I'm going to zoom in, even the past year, as interest rates have been going down, mortgage applications haven't gone up significantly. You can see they've peaked a little bit here. They've gone up, but compared to the 5-year chart, that's like a little blip compared to this whole large section where mortgages were very, a lot of were being applied for. So what does this tell us? Again, it means that maybe there are a couple of buyers out there who have said, hey, interest rates are a bit lower. I'm either going to buy a new place or refinance my existing mortgage. But it hasn't been the uptick that sellers would have been expecting. So what does this all mean for the market? It means that we could be in a time where inventory is going to go up, and we're going to start maybe seeing some price reductions from sellers who are really looking to get rid of their either house or multifamily property. It's not going to happen overnight. This typically takes 3, 6, sometimes 12 months to play out, but it will happen steadily, and that will be good for anyone who's in the transaction industry, like we are at City Point, or anyone who is really looking to purchase a new place or a new multifamily property. Last thing I want to go over is what we're to expect in the future. So there are 2 more Fed meetings coming up in 2024. Here's a headline from The Hill. Fed president expecting smaller cuts after half-point reduction. I've heard JP Morgan currently internally are pricing in 1.25% of cuts. This was before last week's Fed meeting, so they've already gone half a point. That would mean that in the subsequent remaining 2 meetings of the year, the Fed would have to cut one of them by a quarter point and another one by a half for those expectations to be met. The long story short of it is the Fed will do what they do, but it's really the lending market which will determine the real interest rates which people are getting. And as we saw in the previous 2 charts, interest rates, what you'll actually get, have already been coming down the past few months, and they will continue to come down. So that will expose more of where buyer sentiment is. Is it that interest rates were too were too high, that were causing were causing them to not be able to afford multifamily and single family properties? Or was it that prices are simply too high and that they need to come down in order for buyer demand to go up? So that's a question. Keep a look out as these charts move in either direction, and how does that correlate to the buyer demand and the supply from sellers?